If you're watching this and it's getting close to 30 June 2026, this is your reminder that March and April are when smart tax planning starts. If you wait till June to organize your business tax planning, it might already be too late. Right now is the ideal time to review your numbers because the decisions you make before 30 June can legally help you reduce your tax bill. Hey, welcome back. I'm Molly, founder of Above Advisory and a certified tax accountant with over 15 years experience helping business owners and investors legally reduce tax and build long-term wealth. If you want practical tax strategies explained clearly, make sure you are already subscribing to this channel here. Now, let's get into it. Today, I'm sharing 8 key strategies for tax planning tips before 30 June 2026 for your business. Number 1. Review and understand your business profit and tax position before the end of financial year. This is the very first step to tax planning, is knowing your numbers early. Too many business owners only look at their financials when their accountant asks for it at the end of the financial year. Instead, you should be reviewing your profit and loss and business position before 30 June. So this is what we do with our clients during tax planning sessions, which typically starts from March. We will review your past 9 months of trading activity and forecast what your business position will be till the end of the financial year. This will then give you the clarity how much tax your business is likely to pay, and if there are any tax minimizing strategies we can help you implement. Some of the tips we usually discuss is if your business is making higher profit than expected, you may want to review your business expenses, bringing forward deductions, reviewing your timing of when you're incurring your revenue, or other eligible business deductions like maybe making additional super contributions or other tips. Number 2 is reviewing your super contributions. This is something most business owners forget to review before the end of financial year. As a business owner, if you have employees, you need to make sure that you pay your employees super before 30 June. I say this all the time, in order for those expenses to be tax deductible in the business for the same financial year. If you process the payments after the end of the financial year, those payments will only be tax deductible in the next financial year. That's why timing is very important here when it comes to super. If you are a sole trader or run your own business, you can also maximize your super contribution for yourself to reduce your overall business tax bill. I've created a separate video about how Super Envision can help reduce your business or personal tax, so make sure you check the video out here. Number 3, instant asset write-off. This is something most business owners get it wrong, as there have been changes to tax regulations on this topic over the past few years since COVID. If your business has an aggregated turnover less than $10 million each year, you may be eligible for this instant asset write-off. Under the current rules, you can immediately deduct the full cost of eligible depreciation assets that cost less than $20,000 per asset. There are 3 important technical conditions to be considered though. The first one is the $20,000 threshold applies per individual asset. The second one is the asset must be first used or installed ready for use by 30 June 2026. The third one is it must be an eligible business asset. This means multiple assets can qualify provided each item is under the threshold. For example, if you purchase several separate assets like equipment, tools, laptops, they will all still qualify as long as each of them meets the condition. Timing is very important here. It's not about ordering the asset. It must be installed and ready to use before the end of financial year. Personally, I will focus and emphasize on this tax planning tip because this might be the last financial year that this instant asset write-off still exists. There have been discussions by ATO and the government that they might remove this in future years or reduce the threshold amount on the deduction. Number 4. Prepay your eligible expenses. If you run a small business, you may be eligible to prepay up to 12 months of certain deductible expenses and claim the deduction in the same financial year. So for example, common examples include like rent, business insurance, software subscriptions or professional memberships, and certain service agreements. The key principle is timing. If the expense is genuinely for your business, and would be normally deductible, bringing the payment forward to June may accelerate the deductions into the 2026 financial year. However, this strategy should always be considered alongside cash flow. You shouldn't be over prepaying expenses purely for tax purpose. It should also make commercial sense. Number 5, review your business structure. I always say this to my clients. Tax planning is not always about spending more, claiming additional deductions. Sometimes it can be reviewing your current business structure to see if the structure is the right fit for your business. Having the right business structure can also help you with reducing your overall tax bill. Take my client Peter as an example. When we initially onboarded him, he was operating under a sole trader structure because he recently started his business and wanted to reduce the startup costs, which is totally understandable. But his business took off very quickly, resulting in close to 200K profit in the very first year. We reviewed his business structure, discussed future planning, and assisted in restructuring the business into the company structure for both asset protection and also help him reduce his overall income tax bill. I know this may not work for all business types, so you need to speak to professionals like us who specialize in business structuring to make sure your business is still operating under the ideal structure that suits your circumstances. Number 6. Trust distributions. If you operate through a discretionary trust or have a family trust, part of your business group structure, trust resolutions must generally be made before 30 June to determine how the trust income is distributed. Most business owners think they can decide how the trust distributions are going to work among the family member after the financial year ends, but this is basically breaching ATO regulation, and if trust resolutions are not properly documented on time or before 30 June, the trustee can be liable up to 47% of income tax bill. So remember that this is not an optional. Best practice is to review estimated trust income early, decide on your distribution strategy in advance, and make sure documentation is completed correctly before the year end. This is one of the most important compliance deadlines in tax planning. Number 7, review directors' wages and dividends. This is also another very important topic for tax planning tip that you should be considering before the end of financial year. When we discuss tax planning, it's not always about reducing the tax bill. Sometimes it's about planning ahead for the next financial year. You may need to ask these questions to yourself. Do you intend to purchase an investment property or get a mortgage in the new financial year? Do you intend to reinvest your profit back into the business? Do you intend to grow your business? If yes, then how so? All these questions will assist in determining how much you should be paying yourself as a director wages or dividend to make yourself from the business. Making decisions on topics like this around March or April is significantly important so that you can also review your BAS if there are going to be any changes to your wages to allow sufficient cash flow for additional wages or super payments. We understand this can be a very complicated matter, so we assist our business clients review this with us, and we provide them with holistic advice so that they are ready to enter into the new financial year feeling they have their finances and business under control. Number 8, write off bad debts or review stock. Lastly, for businesses using accrual accounting, bad debts must meet 2 conditions to be tax deductible. Number 1, income must have been previously included in accessible income, and the debt must be physically written off in your accounts before 30 June. Only then it can be claimed as a tax deductions in the same financial year. If you are holding trading stock, you should also review your stock obsolete or damaged stock before financial year ends. Ensuring appropriate valuation methods for your stock take are applied and documentation is maintained. Stock adjustments and bad debt written off can have a material impact on your taxable income, so they should not be overlooked every financial year. Now let me be clear. Don't spend money just to save tax. Every decision should also make a commercial sense first. Tax planning is about timing, structure, and strategy, not unnecessary spending. The earlier you start, especially in March and April, the more flexibility you have before 30 June. If you want to stay ahead and make smarter tax decisions before the end of 2026 financial year, make sure you are subscribing and liking this channel. Let me know in the comment below if you book a tax planning session with your accountant for this financial year for your business. See you next time.